Most people think if you make over $200,000 a year, you're automatically approved for any mortgage you want. But today, I'm going to show you a real breakdown of a couple earning $225,000 a year who still got denied for a loan, FHA and conventional. Their income was $225,000, still denied. And trust me, this one surprises a lot of people. We've got a couple with combined income of $225,000 a year, which works out to about $18,750 a month before taxes. They're looking at homes in the price range of $725,000. That's very typical price point in New Jersey. Now on the surface, they look great financially, but here's what the lender sees, their monthly debts. So in this case, borrower 1 has about $750 a month in student debt, and borrower 2 has about $450 a month, for a combined debt of $1,200. They have car payments in total of $1,220 a month, credit cards at $375 a month, and a personal loan that equals up to $400 a month in minimum payments. Their total monthly debts is $3,195 a month. Let's start with FHA. They put 3.5% down. Let's use a rate of, let's say, 6.25%. That gives us a monthly mortgage payment of $4,383. In New Jersey, in that price range, we can average anywhere from $800 to $1,500 a month. For this scenario, we're going to use $1,300. And we're going to use monthly homeowners insurance of about $120 a month and the FHA mortgage insurance of $321 for a total payment of $6,124. Now, add in their monthly debts of $3,195, their total monthly obligations jump to $9,319. Now we calculate the DTI. For those of you who don't know what DTI is, that's your debt to income ratio. We will take $9,319, divide that by the monthly income of $18,750, and the total DTI is 49.7. FHA usually allows up to about 50 to 55% DTI if the automated system approves it. So here's the result. Borderline possible denial. If anything comes in just a bit higher, for example, homeowners insurance jumps up just even a tad, or a new debt pops up, they will not qualify. They're right on the edge. One lower credit score, one missing document, one slight income adjustment, and they're out. So let's now see the same couple trying to buy with a conventional loan at a price point of $725,000. In this scenario, this couple puts down 5%, and let's use a rate of 6.75%. The principal and interest is $4,467 a month, taxes $1,300, insurance $120, and the PMI of $155. Total conventional payment of $6,042 a month. Let's add their debts again. $6,042 plus $3,195 equals $9,237 a month. Let's calculate that DTI of $92.37. Divide that by the total income of $18,750 a month, and we have a DTI of 49.2%. Conventional loans usually max out around 45% DTI. Some lenders go slightly higher, but not this high. In this case, you can see how they got denied. So how does a couple making almost $250,000 a year still get denied? It comes down to one number, DTI. That's the income ratio. The DTI equals total monthly debts divided by monthly income. The lender does not care about how much you bring in. They care about how much you already owe. And when you stack student loans, 2 car payments, credit cards, and a personal loan, your DTI skyrockets. High income doesn't beat high debt. How they can get approved: pay off a car loan, reduce credit cards, refinance student loans, bring larger down payment, add a cosigner, switch from conventional to FHA, consider a lower price point. If you want to know whether your numbers pass or fail the DTI test, DM me the word DTI and I'll run your full breakdown. No guesses, no pressure, just real numbers based on your situation. Same couple, same income, same price range. They're still shopping at around $725,000. Their income of $225,000. They're trying again. This time they made 2 smart moves before applying again. They lowered their monthly debt by $1,065. So let's go back to our FHA scenario of the purchase price of $725. Total monthly mortgage payment of $6,124. We have the new debts of $2,130 equals $8,254. We'll take the $8,254 divided by $18,750 with a new DTI of 44%. FHA will approve that all day. FHA loves compensating factors like strong income, solid work history, and now a much lower DTI. 44% is well within the FHA's comfort zone. So let's try the conventional loan again. Our monthly payment of $6,042. Let's add the new debts of $2,130 for a total of $8,172. The $8,172, divide that by the total income of $18,750 equals 43.5%. Conventional feels comfortable with that number all day as well. Approved. Conventional loans usually cap DTI around 45%. At 44%, this couple slides in comfortably, especially within good credit and savings. So what changed from the denied to approved? Not the income, not the home price, not the loan program. They eliminated a car payment. $540 less per month makes a huge impact. They lower credit card utilization, better credit score, plus lower monthly minimums. They refinance the student loan, lower monthly payment equals lower DTI. They planned ahead. This is the part most buyers skip. These small adjustments saved them over $1,000 a month in debt obligations, which completely changed their loan eligibility. Here's the big lesson. You don't always need more income to get approved. You need the right debt structure. DTI approval strategies work. If you want me to run your numbers and show you what needs to change to get approved, DM me the word approved and I'll break it all down for you.